Two Germans made 50,000 euros on Bitcoin last year. One paid 21,000 euros in tax. The other? Nothing. Same country, same profit, wildly different outcomes. And here's what annoys me. The person who paid 21,000 euros didn't do anything wrong. They just didn't know one rule that's literally written into German law. So, in this video, I'm going to show you exactly what I would do if I wanted to pay zero tax on crypto in Germany. Legally, of course, and the mistakes that will cost you thousands if you're not careful. Germany is incredible for crypto investors, but most people have no idea how to use the system properly. Here's what I'm covering: the 1 year rule, the trade that accidentally triggers a huge tax bill, the 1,000 euro trap that catches pretty much everyone, why I'd never stake without knowing this one thing, and how to turn losses into savings. Let's start with the one that matters most. The 1 year rule. In Germany, if you hold crypto for more than 1 year, you pay zero tax when you sell. Zero. Big fat zero. Not 10%, not 20%, zero. I can't stress this enough. Zero taxes. And there's no cap. You could make 1,000, 10,000, 100,000 euros, even 1 million euros in profit. If you held for over a year, you keep it all. Let's compare that to stocks. Stocks are always 25% capital gains tax. Always. Doesn't matter if you hold for 1 year or 50 years. But crypto, different game. This is why I think crypto is actually one of the smartest investments in Germany, if you know how to play the holding period game. But here's where people mess up. First of all, it's not 365 days. It's 365 days plus 1 day. So if you buy Bitcoin on January 15th, you can sell it tax-free starting January 16th the next year. Not the 15th, the 16th. I know this sounds pedantic, but I have seen people get hit with unexpected tax bills because they just sold 1 day too early. And that 1 day really does make a difference. Secondly, trading crypto for crypto counts as selling. This is the one that absolutely destroys people. You buy Bitcoin. 8 months later, you trade it for Ethereum because you think ETH is about to run. You think, I'm still in crypto, no tax event. Wrong. That is a taxable sale. You only held that Bitcoin for 8 months. Not 366 days. I'll come back to this later because it is critical. Thirdly, there's no maximum. During the last bull run, I knew someone who made 400,000 euros on a single Bitcoin position. He held it for 14 months. He paid zero tax. That's 400,000 euros completely tax-free. Show me another country where that's possible. Let's put all of this into an example real quick. First, let's pretend you're in the 42% tax bracket. You bought Bitcoin in January for 40,000 euros. November that same year, it's at 60,000 euros. You're now up 20,000 euros. If you sell, that's 8,400 euros gone to taxes. But if you wait until February next year, let's say it's even higher, 65,000 euros. You're up 25,000 euros now, and you pay nothing. Nothing. That's what I mean when I say Germany is great for patient investors. Okay, what if you can't wait a year? What if you need to sell sooner? Well, Germany gives you a 1,000 euro yearly exemption. But this is where it gets slightly weird. Most people think, okay, I can make 1,000 euros tax-free. Then I pay tax on anything above the 1,000 euros. See, that would make sense, but that's not how it works. I know someone who made 1,050 euros in short-term gains. She thought she'd pay tax on the 50 euro over the limit. Instead, she got a bill for 400 euros. Why? Because at her income level, the tax rate was 38%, and she had to pay 38% on the full 1,050, not just a little bit over the 1,000 euros, because it's a cliff, not a slope. So if you make 999 euros, zero tax on that. If you make 1,000, zero tax on that. But if you make 1,050 and you sell that, you pay tax on the full 1,050 euros. Here's what I would do. If I'm sitting at 800 euros of profit in November, I'm pretty much done trading for the year. I'll be waiting until January. If I'm already at 1,200 euros, I'm not going to try and get back under the 1,000. I've already lost the exemption. I might as well optimize for total profit at that point. The key is tracking this monthly, not in December, monthly. Any transaction you have, note it down. By September, you need to know where you stand. Now, let's go back to the crypto to crypto trap that I talked about earlier. This is the one that costs people the most money, and I see it all the time. You buy Bitcoin, you held it for 8 months, it's up 40%. You see Ethereum starting to pump and you want to get into that, so you rotate into ETH. You think, I'm not cashing out, I'll still be holding crypto. No taxes, yay! So you go on Binance, you trade your Bitcoin for Ethereum. Wrong! The tax office will see 2 events. Number 1, you sold Bitcoin, which is now taxable because you held it for less than a year. And number 2, you bought Ethereum. Your holding countdown starts today. Not when you bought the Bitcoin, today when you bought the Ethereum. The countdown reset. To sell that Ethereum tax-free, you now have to wait another 12 months. Like I said, not from the day you bought your Bitcoin, but the day you bought the ETH. And this principle applies to every single trade. So what would I do? If my Bitcoin is 11 months old and I want to switch to Ethereum, I'm just gonna hold off for a month. I don't want to sell the Bitcoin, pay taxes on the Bitcoin, and then buy Ethereum. 1 month won't make that much of a difference. Yeah, the price might move in that month, but I would rather pay a bit more for ETH than trigger a tax bill. That's just being smart with money. But the first in, first out rule makes this a little bit more complicated. It can never just be easy, can it? If you bought Bitcoin 3 times at 3 different prices throughout the year, you don't get to choose which batch you sell. You sell the oldest batch first, then the next oldest. So when I sell, let's say 6,000 euros worth, I'm automatically selling all the 5,000 euros that maybe, let's say I bought that in January. This may be tax-free. Then I sell another 1,000 that I bought in March, which probably is going to be taxable. Each of these cells is going to have different tax treatments. Now, here's the thing. Doing these FIFO calculations manually when you have multiple buys across Binance, Kraken, Coinbase, and even DEXs, it's genuinely a nightmare. I used to do it myself with spreadsheets a few years ago. This took me an entire weekend every time, and I still wasn't sure I got it right. So now I recommend Blockpit, and it will make your life so much easier. You connect your exchanges, it imports everything, it applies FIFO automatically, tracks your holding periods, and generates the actual German tax form that you will need. When a client had 200 plus transactions last year, it calculated everything in 10 minutes. 10 minutes manually, that would have taken me days to sort out. The report it spits out shows the tax office exactly what they need to see, which is important if you ever get audited. There's a free version if you want to check it out. The link is in the description. Quick one, type spreadsheet in the comments if you too use a spreadsheet to keep track of everything. I'm curious to see just how many of us chose to torture ourselves that way. All right, staking and lending. Different rules, different game. If you're earning yield on crypto, staking, lending, liquidity pools, the tax treatment is completely different from everything we've just talked about. And of course, most people get this wrong. This is taxed immediately. When you receive staking rewards, that's taxable income the moment you get it. Not when you sell, when you receive it. This is treated like salary. You pay tax on your salary when you earn the salary. It's not when you spend it. Same with staking. Let's say you stake, 20,000 euros of ETH. You earn 4% a year. That's 800 euros in rewards. You owe tax on that 800 euros the moment you receive it in your wallet. If you're in the 38% tax bracket, that's 304 euros that you owe in tax, even if you never sell that ETH. Even if that ETH crashes and your rewards are now worth 300 euros, you're still gonna owe 304 euros based on what it was worth when you got it. And here's the annoying part. There's a 256 exemption for crypto income. But of course, it's another cliff. 256 from staking, tax-free. 257 euros from staking, you get taxed on the full amount. So you get 800 euros in staking rewards, you pay 304 euros in tax. 6 months later, you sell those rewards for 1,200 euros. You made 400 euros profit on those rewards themselves. Guess what? If this happens within a year, that 400 euros is taxed again. You just pay tax twice on the same crypto. So here's what I would do. If I'm staking, I'm converting 35 to 40% of every reward to euros immediately. I need cash to pay that tax bill. And the rest, I'm gonna hold that over a year so the gains are tax-free. I'm not gonna pay tax twice on the same cryptos. But honestly, I would question whether staking is even worth it. 5% APY sounds great until you realize after taxes it's 3%. And you've added a ton of complexity to your tax return. Sometimes passive income just isn't worth the headache. Okay, but what if you're down this year? There's actually something useful you can do. If you made some winning trades and some losing trades, you can offset those losses against your gains. For example, if you made 5,000 from Bitcoin, another 2,000 from Solana, but you lost 3K from Ethereum, then you're only taxable on 4,000 euros. Not 7,000. At a 42% tax rate, that means you're saving 1,260 euros in taxes. So here's what smart people do in November. They look at their portfolio and ask themselves, what losing positions can I sell before December 31st? Let's say earlier in the year you sold Bitcoin for an 8,000 euro profit. Now it's November. You're holding ADA and you're down 2,500. And Polygon, which is also down 1,000 euros. If you sell both of these before December 31st, you've now realized 3,500 euros in losses. Your taxable gain drops from 8,000 euros to 4,500. The tax you saved at 42%, 1,470. And there's a fun part. Germany doesn't have a wash sale rule. In the US, if you sell for a loss, you have to wait 30 days before you can buy this back. Germany doesn't care. You can sell Cardano at 10 a.m., buy it back at 10:01, and the loss still counts. Now, I'm not saying you should be doing this. Price could move against you, but legally, it's allowed. If your losses are bigger than your gains, you can carry this excess forward to future years, indefinitely. Or you can carry it back to last year and get a refund on your taxes. But remember, the 1-year rule still applies. Now, there are 3 things that can mess you up with your taxes if you're not careful. Number 1, time zones. Most exchanges show timestamps in UTC, not German time. Your holding period is calculated in German time. So make sure you're always converting to German time. Number 2, the DeFi extension. If you use crypto to earn income, so like I said, staking, lending, providing liquidity, some interpretations say your holding period extends from 1 year to 10 years for a tax-free sale. The 2022 tax guidance created a little bit of confusion. There's no clear legal precedent yet. The best approach, in my opinion, keep 2 separate wallets. Wallet A, this is pure holding. Never staked, never lent, never touched DeFi. That's your 1-year tax-free bucket. Wallet B, everything that generates yield that might have a 10-year holding period. Is this conservative? Yes, but I'd rather be conservative than get a surprise tax bill 5 years from now. Number 3, the I didn't cash out mindset. This is a psychological trap that destroys people. I already explained this earlier, but this is so important to remember. This is when you think, I didn't convert to euros, so it doesn't count. Wrong. The tax office simply doesn't care if euros hit your bank account. They simply care about the economic event. The moment crypto changes form or generates income, that's a tax event, so track it. Alright, let's bring this together. I know this has been a long video, guys, but just a little bit more. If I were starting from scratch today, here's exactly what I would do. Step 1, document everything. First of all, I'm documenting every single purchase date in German time. For each crypto position, I will be noting which coin I bought, how much I bought, what the purchase date is in German time, and when the tax-free sell date is, which is, of course, the purchase date plus 366 days. I'm putting all of this in a spreadsheet or using some kind of software like Blockpit. Doesn't really matter what I'll be using, but I will be tracking it. Step 2, set calendar reminders. I will be setting a reminder for each tax-free date. Why? Because I'm not trusting my memory when there's potentially tens of thousands in taxes on the line. Step 3, I will never trade near the 1 year mark. If I'm 11 months into holding Bitcoin and I want to switch to Ethereum, I will be waiting. 1 month. That's it. I don't care if Ethereum is about to pump. I've seen people lose 10,000 euros plus in taxes trying to catch a move 1 month early. It's just not worth it, in my opinion. Step 4, tracking my short-term gains every month. I'm not just going to wait until December to track these. By September, I will know if I'm approaching that 1,000 euro limit. If I'm at 800 euros in October, I'm probably done trading until January. Step 5, treat staking rewards like income. The moment I receive staking rewards, I will record the date, record the euro value, set aside about 35 to 40% in cash for taxes. And I'm holding the rest for over a year before I sell so that the gains are tax-free. But honestly, I'm probably just going to hold that and skip staking entirely. The 1 year tax-free rule on price appreciation is way more valuable to me than 4% staking yields that gets taxed twice, potentially. Step 6, November tax review. Every November, I'm doing a portfolio review. Am I over the 1,000 euro short-term limit? Any losing positions I should sell for tax harvesting? Is anything approaching the 1 year mark? 30 minutes in November is going to save me thousands in April. Step 7, I'll be keeping records for 10 years. The tax office can audit you for up to 10 years if they suspect tax evasion. So I'm keeping literally everything. Transaction confirmations, exchange statements, wallet addresses, price calculations, literally everything. If they ever audit me, I want documentation that's bulletproof. I know this might seem a bit extreme, but I just don't want to get hit with another tax bill. If you thought this video was helpful, then please hit the like button. It's gonna help so many more people find this video. And please subscribe to Crypto Tax Europe, because I'm doing this for every European country. Portugal, France, Netherlands, Austria, Switzerland, they all have different rules and most people have no idea what they're doing. Look, Germany is genuinely one of the best places in the world to invest in crypto. The 1 year tax-free rule is incredible. Most countries make you pay capital gains forever. 10%, 20%, 30%, doesn't matter how long you hold. Lastly, drop a comment and tell me what country are you in and what crypto tax topic do you want me to cover next. I read every comment and your questions literally drive what videos I will be making next. And look, I'm not a tax advisor. This is purely education. This is not personal tax advice. If you've got a complex situation, please talk to a professional. But at least now you know what questions to ask.